Hi everyone, we will look at consolidated statement of financial positions disposal, or we call it a part disposal. So we have a few scenario over here. We're going to start with these 4 illustrations and we will go into the real exam questions. Now, disposal is something that opposite of acquisitions. So if today your business is intended to divest certain subsidiary or divest associate, this will be fall under disposal. So now let us quickly look at what we have in these questions. Illustrations 1, we are parents and we have one subsidiary and we are intended to dispose of afterwards. So based on this scenario, we are actually holding 40% of their holdings, NCI equivalents to 40%. So when we talk about the NCI, they are valued at full goodwill method. So fair value at NCI are 800. And we have this statement of financial positions at the year end 31st December 20x5 with all these informations given for us to deal with this disposal. First, P, they acquire this 60% on 1st January 20x5. So meaning to say the beginning is 1st of January 20x5 and you are doing the year-end closing for 31st December 20x5. The RE at the day is actually 500. So this is your pre-acquisitions RE. Number 2, P dispose half of the shares in S on 1st July 20x5 for 1,000. So guys, this is where the disposal happened. From 60%, you are going to dispose half of it. And the proceed not yet collected. So meaning to say it's a receivable to you. And the third additional information is telling you that the fair value of the remaining of the share worth 1,002. So 60%, 30% you transfer out, half of it. So another 30% actually retain in the business. So that 30% actually worth 1,200. Assume the profit accrue evenly throughout the years. So if you still can recall what I've told you in the previous video, when we are doing a consolidations, meaning to say if today I have bought over a subsidiary, I will need to recognize their net asset. So their net asset is their total asset and their total liability will be attached together with my books. So assuming I will debit their net asset for a certain amount. And if I paid anything extra for their over their net book value, that will be the goodwill. And I'm going to recognize as the debit side. Correspondingly, when you are not 100% invest in the subsidy, there are certain portions of the people's, we call it as a minority interest, you will need to recognize their so-called the holding. We call it as NCI. And you will pay the amount of bank in the credit side. So that will be your double entry. So this is on acquisitions, or we call it as consolidations. You have it as your subsidy. But if today, particularly for these 3 items, when that particular subsidy is going to loss control, meaning to say you have lost control over the subsidy, you are going to de-recognize your net asset, meaning to say you will stop console their asset and liability in your account. You will de-recognize it, put it under credit side. Put it under credit side. So when this is disposal, and you are going to de-recognize your goodwill, and you are going to de-recognize your NCI. So this is what is going to happen. And another remaining portions is actually your proceed of disposal. We call it as bank. So this is where your business is console a subsidy. This is where your business is disposed a subsidy. So actually it's just reverse. With that, let us look at what are the procedures that we will need to go through. First thing first, we will need to analyze the situations now here. So let's look at the structure. So on 1st January 20x5, which is the first date, we are holding 60%. Subsequently, after 1st of July 20x5, we will let go 30% and we still keep 30%. that time, the point of time, it will become your associate. So this part will be your subsidy, this part will be your associate. And if you look closer on these things, your questions tells you that at the beginning, when you invest on 1st January, you have a retained earning of 500. And at the end, your retained earning at 2,000 for your subsidy. So it is very important for you to take note that whenever there is a disposal of subsidy to become associate. So just to make it clear, this is subsidy and this is associate. So when disposal happen, you need to know what is the retained earning at the date of change. So to do this, you will need to know how to calculate your retained earning. So your retained earning technically is using the brought forward retained earning plus all the profit in this year. So obviously we know that 2,000 final retained earning, opening retained earning is 500. So during the year, increased by 1,005. So the question says assume the profit accrued evenly. So meaning to say, here's 6 months, here's 6 months. So I'm going to use 2,000 minus 500 times 6 divided by 12 because the entire 1,005 is for 12 months. I only want to know the 6 month. So the 6 month profit is 750. Therefore, if I use 500 plus 750, you are going to get 1,250, which is the retained earning at the date of control loss. And of course, if you want to do the same thing, you will derive at 2,000. So we are clear about the working. Now, let us calculate goodwill. It is important for you still calculate goodwill during the disposal date because you are required to de-recognize your goodwill. You need to know what is the amount. So, same things, goodwill, considerations 1,002. Over here, investment in S. NCI measured at 800. So total 2,000. And we are going to minus our net asset. So net asset here, we have 1,000, which is their shares in the subsidiary, and the pre-acquisition retained earning 500. So the total net asset will be 1,005, and your goodwill will be carried at 500. So this is the goodwill. And after we share the goodwill, retained earning will be one of the very important steps. As per questions, post-acquisition retained earning, parents, we have 3,000. Subsidy, during the times of 60%, 60% will be end in this period. So their post-RE is 1,250. And subsequently will become associate. Associate, we will use equity accounting to account for our retained earning. Therefore, associate ending post-acquisition retained earning is what? 2,000. And we will need to minus the pre-acquisition retained earning. Same things. In our subsidy case, this is post, therefore this is pre, minus the 500. Associate case, this is post, this is pre, sorry. Therefore, the net amount will be 750, 750. So we will share this 750 using the 60% subsidy, another 750 using the associate holding. You will carry at 3,675. And in here, we will need to hold on. As you can see, I leave one places for this particular items. This item, we will call it as profit on disposal or loss on disposal. Please bear in mind, every time when we are going to dispose, we lost control of subsidy, we are going to calculate profit of disposal or loss of disposal. And before we do that, profit or loss of disposal, technically we can use this disposal journal entry to find it out. Later we will see. Now, so in NCI, we will need to calculate up to the date of control loss. What is my NCI value? Because this NCI I will going to de-recognize as well because no longer, S is no longer my subsidy. So my NCI at the date of acquisition according to goodwill is 800 and according to question as well. And I will need to share, NCI will need to share this 750 to them. 60% to them, 750, 40% to NCI. So NCI at the date of control loss will be 1,100. And now we are ready to calculate our profit or loss on disposal. So profit or loss of disposal, first thing first, I'm going to take my fair value of shares that I transferred, I received the money, which is 30%. So they dispose half of the shares for 1,000. So this 1,000 is the half of the shares you receive the money. And another 30% will be carried as your associate. As question mentioned that the fair value of the remaining of the shares is 1,002. So total initially you got 60%, 30% going up, you still got 30% carry as the value of associate. You de-recognize your subsidy, but immediately you are going to recognize your associate. So your total 60% is equivalent to 2,200. So you will need to calculate, you will need to compare with the carrying amount of your subsidy, or I call it as net asset at the date of control loss. So the carrying amount of your subsidy, you will need to take your net asset, which is your 3,000. But this 3,000 of your subsidy, right, is actually reported at the end of this day. So what you are going to do now is, we will need to bring it back to the date of control loss. So during this period, we got 1,005 profit, because as you can see, retained earning is 1,005. I will need to minus up the 6 month profit, so that I can move my net asset from 31st December back to 1st of July. So this is why I need to minus, and I will derive at 2250. And I will need to include my goodwill as well, because this goodwill already realized. And I will need to take into account NCI as well. So we will be derived at the carrying amount of your subsidy, which is 1650. This is what you have, what you receive, and what your associate value. And this is what you lost in terms of the carrying amount. So if you minus it, obviously you will see there's a profit on disposal, and you are going to transfer this profit of disposal, report it in your retained earning. And your retained earning will be 4225. So how to explain this part? So actually, if you were to put it under a journal entry, that will be more clearer. We have a debit and we have a credit. So let's say we are saying that for the 30% transfer, we receive money, so I'm going to debit bank. For the another 30%, I will recognize as associate in my books after the date of loss of control. And the net asset is the asset and liability up to the date of loss control. I'm not going to recognize the subsidy asset and liability in my books, so I will need to take it out. So I will de-recognize the net asset of my subsidy, which is at 2,250. And I will de-recognize my goodwill as well. And I will de-recognize the NCI. NCI in credit side, I de-recognize, it will be in debit side. And if we were to do a balancing, so must be equals to 3,300, because the amount is the largest one. And I use 3,300 minus this, I will get back the profit in a credit side as a gain. So this is gonna be my profit on disposal. So what we are doing in here, I recognize the amount that I receive in terms of the money proceed, and I recognize my associate, because now it becomes my associate, and I de-recognize these three items because of consolidations already no longer valid, and I will recognize the balancing figure as my profit in here, or loss in debit side. So that will be well explained this part. Subsequently, after you have de-recognized, you have already recognized the profit of disposal under your group retained earning. So this is my group retained earning. And immediately, I will start with my associate. So associate value, you recognize in 1002. So this is my cost of associate. Using equity accounting method, I will need to share after the 6 month, the retained earning. So the amount will be 225. This 225 is coming from here. As per the last video discussed, we will debit associate when there is a share of profit. We will credit our retained earning. Increase. The value of associate has been increased. So after this part, no longer we need to do consolidations. So we only tag our P amount. So let's see. So our P amount started with the non-current asset, PPE, 3008. And I will recognize my associate value according to my, this one, carrying amount of associate. Okay. And after that, my current asset, I only recognize 3,000 plus the 1,000 that proceed of disposal not yet collected. Because this 1,000, when you debit bank, right, actually is something that we haven't collect. So maybe we can just put debit receivable. Okay, therefore your current asset will increase. And total up, that will be 9225. And we will have our equity, which we are going to put 4,000. And the group retained earning 4225. And lastly, my liability. And you will balance. So this is how we do the subsidy to associate. What about now we are doing subsidy, dispose certain part of the share, but they are still considered subsidy. Or could be subsidy changed to investment, meaning to say they go one level beyond the associate. Now let's look at the second illustrations. So the second illustrations will be subsidy to subsidy. In the sense of you are still retain the coding. Now, example still the same. We are still holding 60% and P dispose 50% in S. Sorry, this example is you totally lost control. So initially we have 60% and we dispose 50%. So we still retain 10%, meaning to say this is not subsidy to subsidy. This is subsidy to IFRS 9 financial instruments. So meaning to say we will lose control as well. So this scenario and this scenario is actually almost the same. So what we are going to do in here, let's analyze. Same things. Retained earning at the acquisitions is 500, closing 2,000. So we accrued evenly. We know that 1,005 times 6 divided by 12 is 750. Opening 500 plus 750, you get 1,250. And we will calculate the goodwill like what we did just now. Considerations plus our NCI at fair value, same thing like just now, and minus my net asset. I will get goodwill 500 as well. Can you see? Exactly the same goodwill. We won't touch anything. These two scenarios is actually, I can say mostly are the same. Group retained earning, a bit different because just now there will be an associate. But this one is totally become your IFRS 9 financial instrument. You are not using equity accounting, so we are not going to share their profit. So in here, my post acquisitions for retained earning, parents 3,000, and at the date I stopped console, which is 1,250. That will be my post retained earning. I'm not using this because here is 10% already IFRS 9. And I will need to minus the pre-acquisition retained earning, which is 500. That 750, I will share to my parents at 60% holding. Then, this will be my, as for now, retained earning. But bear in mind, we have a profit or loss of disposal like what we are going to do just now because we lost control. So we will need to calculate profit on disposal. Let's do this by calculating NCI first. Our NCI, as per goodwill calculation, is 800 at the date of acquisitions, and they will need to share the retained earning up to the date of control loss. So this will be the NCI up to the date of control loss. let's do the same thing. Fair value of transferred for the 50% as per question is 1,000. And we will need to recognize the 10% as normal investment under IFRS 9, 700, as per question mentioned. Fair value of the remaining shares value at 700. So total 1,700. And subsequently, we have the net asset, same things. We need to minus the carrying amount at the date of control loss. So the net asset, 3,000, is on this date. We will move back to 1st of July when control loss. So minus the 1,005 profit times 6 divided by 2 so that we can move it back to the 1st of July. Goodwill is part of my net asset, current carrying amount, and minus my NCI. And I will get profit on disposal. Same things, profit of disposal, you are going to transfer to your retained earning. And you will get your group retained earning. Can you see? Exactly method like what we are doing just now. So if you were to present this journal entry, same things. What I'm going to do? I'm going to debit receivable as per question they say haven't collected. So now it's not associate, now it's IFRS 9 investment. So we call it as investment. The value is 700. And my NCI will be derecognized at 1,100. Net asset derecognized. And goodwill derecognized. So my profit, $50. So same things. And after this, statement of financial positions, what we are going to do? We will recognize only P, S or FP amount. So we start off with their PPE and recognize the investment value, IFRS 9 investment, and current asset, 3,000 plus the 1,000 not yet collected. Your equity and your group retained earning. And subsequently, that will be your current liability. And you will balance. So I would say illustrations 1 and illustration 2 is highly similar. What about now? We go into 60% but we dispose 5%. So 60% if we dispose 5%, we still retain 55%. So meaning to say, our control not lost. We are still retain the control. So how are we going to deal with it? And in this scenario, we are not going to calculate any profit or loss. Because this part, we doesn't loss of control on our subsidy. So now, let's start. Same case, we didn't change. 1st of January, 20x8, x5. 1st of July, we lost the 5% and we still retain. So, in conclusion, still subsidy, still subsidy. So same thing, at the beginning, 500, at the end, 2,000. So, the different 1,005 times 6 divided by 12, that will be 750, plus it up. At the point of time, the retained earning at 1,250. Goodwill calculation, I'm not going to explain again. It's exactly the same things at 500. Group retained earning, we are going to start off with post-acquisition retained earning, 3,000, 1,002, 2,000. And minus pre-acquisitions retained earning, like what we discussed just now. And we shared 60% profit retained earning shared to P and 55% shared to P. So we will carry group retained earning before so-called the adjustment at 3863. So unlike with just now that two cases, here is profit on disposal. But now we won't call it as profit of disposal, we will call it as adjustment of equity or remeasurement gain or loss. So let's see what we are going to do in here. So we will need to go into NCI directly. NCI as per your goodwill is 800 as per question as well. And NCI need to share until the date at 60%. So they will share the profit, the retained earning. And NCI will be carried at 1100 at the date where the tax still 40% on NCI. So this disposal while control still retained 60% originally holding by us, another 40% by NCI. So actually, we are buying the 5% from them and we get another 5%. So in this case, we are actually buying the shares we are actually selling our shares to our NCI. So again, they are holding 40%, we are holding 60%. We are selling part of our 55%, we are selling part of our 5% to our NCI. So our NCI will increase. So that 5% actually is worth how much? We will need to base on this highlighted 1,100. We will use 1,100 times 5% that increase in NCI and divided by 40% because this 1100 represent 40%. So based on this carrying amount of NCI increased by 5%, that will be your 138. So meaning to say 1100 equivalent to 40%. That 40%, how much is the 5%? That will be the incremental of your NCI. That is very important working. And subsequently, your NCI will be valued at. So after that, we will need to share after we hold 55%, they are holding 45%. So we will need to share this profit as well. So the NCI will be carried at 1575 at the end of the year. And these particular things highlighted in blue color, very, very important because we will need to ask ourselves, we are actually transferring this 138 value of shares. We are transferring the 5%, which is equivalent to 138 to them. But we collect how much from them? Looking at the question, we dispose 5% in S, which is 100. We receive 100. So if you're looking at working for, we are receiving 100, but the value of the share that belongs to us, the 5% we transfer to them is 138. So in this case, that value is actually worth 138, but you receive 100 from your NCI only, which is a loss to you. So we call it as remeasurement gain and remeasurement loss. Or we will make it we will call it as adjustment to equity. And transfer this negative 38 into our group retained earning. And finally, we will report at 3825 group retained earning. So this is the difference. In here, we don't calculate the profit or loss of disposal. We will calculate how much is the amount of value that we transfer to NCI. And after that, we will do console. So in here, at the end of the reporting date, they are still our subsidy. So we will do console. Our NCA, PPE will plus 3,008 with 4,000. We will continue recognize the goodwill. And we will continue recognize the current asset plus the 100 that we are going to receive from NCI because we dispose the 5% to them. And console the 3,000 with 2,000. We will recognize our equity, group retained earning, as well as our NCI. Continue recognize them. And my current liability, P and S. So that will be my final consolidated financial statement. Because at the end of the year, we are still holding their more than 51% of the shares. So therefore, we will continue console. So this is illustrations number 3. What about illustration number 4? This is very interesting because we doesn't loss of control, but we loss of significant influence, which is from associate to investment. So our P and S now currently is an associate, S is an associate, and we acquire on the same date just at 30%, dispose 20%. So meaning to say, from associate to normal investment. How are we going to account for that? Technically, this is more straightforward. If you look at 1st January, we have 30% and we dispose 20%, we will still have 10%. So from our associate to IFRS 9 investment. And again, at the beginning, 500 share of profit because the ending is 2,000. So 750 plus 500, you will get the amount of 1250. And let's start with the good view. Sorry, they are not going to be any good view because this is your associate. So we will start with our group retained earning. So P and S, our pre-acquisition retained earning, and minus our post-acquisition retained earning, this amount and this amount. And we will minus our pre-acquisition retained earning. You will get the share of retained earning for this associate, and we will share their 30%. So we will get 3225. Bear in mind, associate means you are the NCI, so you don't have any NCI in here. And we will need to calculate our associate value up to this date of loss of significant influence. So associate value, we invest 1,000 to the cost of associate, and we will need to share the retained earning. As I mentioned, you debit here, you credit here. You debit associate value and you credit retained earning. So the associate at the date of your significant influence loss is 1425. So you got to ask your question again. Is a profit or loss of disposal of associate? So if you receive 1,000, okay, you receive 1,000 because you dispose the 20%, and you keep the 10%, and the fair value is 500 on the date of you lost the associate. So the total value is 1,005. And the carrying value of the associate now is very clear cut, is 1425. Therefore, you will have a profit on disposal of associate. That will be transferred to here, and your group retained earning will be 3300. So since it's just a normal associate, no console, you just focus on P. So I put my P, non-current asset and asset. Remember to plus the 1,000 because proceed disposal not yet collected, and final amount 8,003. And your equity shares for parents, your group retained earning, and finally your current liability of your parent. So you were landed at 8,300. So from the date I lost the associate 1st July onwards until this date, that will be my IFRS 9 investment, which is 500. So there will be the 4 different cases that you can explore when you want to understand more in depth on what this disposal actually happened. Now, let's go into an exam style question so that you can better understand how this will be coming out in your exam. So we have, let's go to the question that is relevant. So we have this question in front of you. So the first scenario is subsidies to associate. So let's look at these questions. So we have our type 1 subsidy to associate. So you will stop console and start to recognize the associate value. Angel Core hold 70% of the shares of Shane for 120,000 on 1st January 2006. At the date of Shane Core, retained earnings stood at 10,000. So you have SOFP, SOPL, and retained reserve for the 2 years. Sorry, for the 2 companies. So Angel Core sell 1/2 of the holding in Shane for 120. So meaning to say 70% they sell 1/2. So 35% retain. So at the date, the fair value of the 35% holding that you retain is worth 130. So you sell the first 35% to other people by collecting 120, and another 35% you keep it as an associate. Value on the day is 130,000. That is your associate. No entry has been made, and assume the profit accrued evenly. This is for you to calculate at the point of change how much is your retained earning, and the non-controlling interest is 51,400. Let's start. So change in group structures. We know that 1st of January is my 6-month associate, a subsidy, and after that will be my 30%, 35% associate. we need to calculate gain on disposal or loss of disposal, profit or loss of disposal at the date of change. So at the beginning, our retained reserve at 72%, 72,000, closing at 90,000. So the incremental is our profit, 18,000, where we understand that 18,000 for 12 months, and we need to know this 6 months, times 6 divided by 12, I know is 9,000. 72,000 plus 9,000, I will get the retained earning at the date of change, which is 81,000. And plus 9,000, you will get 90,000 at the end of the year end. And this is our whole big picture, and now we are ready to go into good view. So good view, as mentioned in the questions, they used 120,000 to buy the 70% of the share, which is the considerations. NCI 51,400. Net asset identified. Your share capital on the date is 100 in Shane, and the pre-acquisition retained earning and 10,000. So this good view, 61,400, happened at the date of acquisitions of this subsidiary. And when you are disposing your subsidiary here, you will need to de-recognize this good view. Third working. Retained earning, we have Shane at 70% subsi, Shane at 35% as our associate. Looking at your working number 1, we will get the amount in here, 81 and 90,000. And looking at your working number 1, 10 and 81. 10 is the pre-acquisition retained earning here, and 81. Then we minus shared 70%, shared 35%. That will be your total, but we will need to pending because we will need to calculate profit on disposal. And subsequently, let's calculate NCI because we need to de-recognize the NCI. We need to know the value. So over here, based on the questions, we know our NCI initially at 51.4 under the good view calculations or under the question here. And we will need to share the NCI will need to share the 71% during this where there is the subsidiary, 30%. So let's calculate profit or loss. So profit or loss, you use your fair value that you transfer, you receive 120. And you use your 130 where you retain. So total, the value is 250 for your entire 70% of the holding. We will need to minus the carrying amount of your subsi during which the control loss. So we will use the subsi net asset 190, but this 190 is at the year end. We are trying to move your 190 in here, the 190 in here. We want to minus out the profit in here so that we can get the net asset on this day. So in this case, I use 190 minus the 18, which is my total comprehensive income that increased the retained earning in here. I minus out the 6-month result. So I will get a net asset on the date of control loss. And plus the good view minus the NCI, you get the carrying amount. Compare it, you will have a profit on disposal. So this is where I use the double entry to present just now, which is this one. Then your amount of profit 80.3, you will move to your retained earning, and that will be your final retained earning figure. So this step is quite standardized. And after that, investment in associate, because your subsidy now changed to associate, you will need to calculate using equity accounting method. Fair value of associate at the date of started to recognize it is 130. You also know in here 130. And you need to plus your share of RE for associate. And the question also asks us to do a reconciliations of your group retained earning for the opening and closing. So this is your closing group retained earning. We need to say on this date, 400. Okay, so we will need to do a group retained earning for the opening. So the group retained earning of the opening, we will use 330 and 72 minus the pre-acquisition retained earning. Share it, then you will get your group retained earning 373.4 at the beginning. And we are doing this because we will need to do a reconciliations over here. Can you see? Opening and closing. We will need to see the movement. And based on what we have in the question just now, this is your SOFP and SOPL. We are only console for 6 months. Can you see? Console for 6 months because we are holding that for 6 months for our subsidiary. After that, another 6 months will be share of profit of associate. Likewise, total comprehensive income, we will share the subsidy for 6 months and share of associate OCI 6 months. So you will need to allocate owner of parent and NCI, total comprehensive income, total for parent and NCI. So NCI, you only take 6 months because subsidy only happen for 6 months. So this is case number 1. So this is the explanations. And what about case number 2? We retain the case. Now, using the same informations, if Angel had disposed 10% of the holding, meaning to say, from 70%, disposed 10%, now it's 60%. So, control still retained. We will do adjustment to equity rather than calculate profit or loss of disposal because that is still our subsidy. As usual, calculate goodwill, share of retained earning, both is my subsidy, just the holding is different, minus the pre-acquisitions, share the profit 70 and 60%, and therefore, stop here, we will need to calculate adjustment to equity instead of profit or loss of subsidiary disposal. So in here, immediately we will need to value our NCI. NCI initially at 51.4, they will need to share the another 30% up to the date of 30th of June. Then the value is 72.7, that represent 30% of the holding. So we transfer 10% to them. NCI will increase by the 10%, which is equivalent to 24.23. So we use 72.7 divided by 30. We know 10% represent one block. I only want to know 10%. Increase by the 10% to 4.23. So we shared another retained earning for NCI at 40%. Can you see their NCI increase already because they already increased by the 10%. And NCI at the reporting date will be 100.53. And in here, let's compare. If today, if you look at this example, they say 10% that we transfer out is actually worth 24.23. We transfer something 24.23 to them, but we collect 37,000 from them. So this is a gain, and we are going to report this gain in our retained earning. That's it. So this is going to be the explanations. And now, let's go to third scenario. So third scenario, dispose 60%, fair value of 10% actually at 50,000. So this is IFRS 9 investment. So 70% is your original holding, you dispose 60%, so you retain 10%. So you have lost the control. You need to calculate profit on disposal of subsidiary. Goodwill, still the same. Retained earning, we will shed the retained earning up to this period because IFRS 9, no more console, no more sharing. And minus the pre-acquisitions, you shed the 70%, you have a profit on disposal need to calculate. Before that, let's calculate NCI. So NCI, as per question or as per the goodwill, 51.4, shared the entire another 30% to them. So just now we share 70% to us, 30% to NCI. So NCI at the date of disposal is 72.7. So do the same things. You use the fair value of consideration, 60% stakes you transfer, 200. 10% retain as your IFRS 9 investment. You minus your carrying amount where your net asset, goodwill and NCI, like what I've explained in scenario number 1. You get your profit, profit will transfer to your retained earning, and that will be your group retained earning. So can you see, whenever there is a disposal of subsidiary where we need to recognize profit or loss, the method is exactly the same. So when you study one method, you already know how to deal with this subsidy to normal investment. What about the last scenario? So after that, you will carry as IFRS 9 investment. What about, okay, this is the explanations. What about the last scenario? In last scenario, we will have a full disposal, meaning to say, we start off with 70% and we full dispose the 70%. Nothing in our business. No console, no associate, no IFRS 9 investment. This is more simple. Calculate the goodwill, calculate the retained earning, like what we explained for the 4th time already, and we need to calculate profit on disposal. Let's do NCI, and we will calculate the gain or loss of disposal. Can you see? Now is 100% we dispose everything. Sorry, to be exact, this will be the 70% stacks. So meaning to say we 100% everything we dispose. And you will transfer this 80.3 to your retained earning. From there, close case, no more investment. So again, if you lost control, you will need to calculate the gain or loss of disposal, or I call it as profit or loss of disposal of subsidiary. So that's it for group disposal. I hope you learned something from this video. And if you like my video, do share to your classmate and subscribe my channel for more accounting standard video. And see you next time. Bye bye.